Good afternoon, everyone, and thanks for joining us today. Our team had an exciting and productive conference, and we are looking forward to sharing our key takeaways with you this morning. Some quick housekeeping items. Please note that this presentation is being recorded and will be publicly available on our website for a period of time following the presentation. And some of our comments today may contain forward-looking statements. Please refer to our SEC filings for information about related risks. When we open today's discussion to Q&A, those on the screen, please feel free to ask questions verbally. Everyone else can use the question and answer functionality on the bottom of their screens. With that, I will turn the call over to Jim to introduce the participants. Jim?
Thank you, Stacy, and thanks to each of you for joining and learning a little bit more as to what we saw and found at the ICSC Recon Conference last week. Did see some of you there. For those of you who weren't, it was incredibly busy. We had over 800 meetings and just some great productivity. So what we hope to accomplish today is to give you some more insights into the nature of the conversations we had with the tenants, the types of tenants that are expanding, some of the issues we noted during the conference, how we're getting after some of the bankrupt spaces and the opportunities that we see going ahead. And you've got the senior team here. Obviously, everybody knows Angela, our CFO, and Stacy, our head of IR. And most of you have also met Brian Finnegan, our Chief Revenue Officer. We also have Tanya Creekmore, who's in our National Accounts Group with a particular focus on out-parcel type tenants, as well as David Gerstenaber, our head of National Accounts. And we're thrilled to have Laura Park Carson join us. Laura is a vice president of leasing in the North and is responsible for driving a lot of the phenomenal results we've had in the North region over the last couple of years. So with that, why don't I turn it over to Brian?
Thanks, Jim, and thank all of you for joining after what was another successful ICSC Vegas conference for the Brixmor team. The turnout for the event continues to grow, exceeding 22 levels for both overall attendance and for retailer turnout by 8 and 9% respectively, again, being the highest percentage of retailers for a conference deal making that ICSC's ever had. Those retailers, service, and restaurant tenants were continuing to look for store opening opportunities as the demand we're seeing for space is not slowing down. And it's consistent with what we've shared in recent earnings calls, and you've seen in our results, and that's that tenants continue to invest in and expand their physical store footprints. The demand for space was particularly encouraging around that at-risk tenant space that Jim mentioned, putting us in a great position to backfill these spaces very quickly with better tenants at higher rents. I'll give you a brief overview of that demand, touch on in a bit more detail what we've heard from tenants at the conference, and then you'll hear from Laura, Tanya, and David from their meetings and what some of their takeaways are. And as Stacy mentioned, we'll take some questions from the audience as well. We went into the conference with a ton of momentum in the business. As we discussed on our 1Q call, we've hit all-time records in rate and occupancy as the investments that we've made and the work the team on the screen and across the company has done in attracting tenants to the portfolio have really transformed it. And in the 700 to 800 meetings that we had was up over 10% from last year with a similar number of Brixmor attendees. We saw retailers bringing out more of their teams this year, more retailers signing up for booths in the South Hall. So that was really encouraging. And in addition to the core tenants that we've been doing a lot of deals with in the value apparel, specialty grocery, quick serve restaurant, wellness segments, there were several new tenants that we met with for the first time at the show. I'll touch on a few of them here on the screen. The first is Heritage Grocer Group, which is the parent company of Tony's in Chicago and Cardenas in California. We've known those regional concepts for a long time, but it was good to meet with a new management team as they look for expansion in other markets. The trend that we're seeing of mall-based and lifestyle-based retailers migrating to open air continued. We had our first meeting with the Fanatics concept by Lids. They still see a void in that athletic team apparel sector since Modell's filed, and they're looking for 5,000 to 7,000 square foot stores. The other was Lovesac, which is another tenant who's primarily mall-based and in higher-end street retail lifestyle centers that is looking for high-profile out-parcel opportunities, similar to the way Sleep Number was when they first started leaving the malls. Laura, in particular, has been talking with them on a few of her redevelopment opportunities. And finally, following the announcement that IKEA made in April, we've been in front of them on some of their showroom opportunities, and they were just one of the many retailers that we talked to over the course of the week that was focused on different formats and different prototypes. Stacy, next slide. We heard a consistent theme at that conference, which is how do we get leases done faster? What are some ways we can get ahead of that troubled tenant space? Tenants want to see what we have coming back, not just in 24, which we're working on today for a number of those deals, but in 25 and beyond as well. Several meetings with tenants included them talking to us about continuing to negotiate LOIs and leases contingent on getting that space back, not waiting till ultimately when we do. And then also that they're being very flexible with format. As I mentioned, one box tenant in particular who we met with a year ago who was only focused on 30,000 square foot spaces, they said they weren't going to go any smaller than that. Well, as they've gone through the Bed Bath opportunity, they've now figured out how to go to 24. So that'll open up more opportunities for them as well. Another tenant who we met with, Dick's Sporting Goods, continues to have a wide range of size options and formats. Their new prototype for the typical Dick's stores at 50,000 square feet. They're also looking at House of Sport opportunities for 120,000 square feet, in addition to Golf Galaxy and some of their more discount concepts. That quote, "It's a great time to be a landlord," came from one of our largest retailers when he was lamenting the competition for good box space as they continue to look for a number of store opening opportunities, even with some of the Bed Bath supply coming online. I'd say from a challenge perspective, retailers are laser focused on the safety of their customers and their employees, as organized retail crime was an issue that came up in a number of meetings. We've been at the forefront of a solution to that, partnering with retailers and local representatives. Heiko Chachin, who runs our operations team, is on the ICSC task force. And the discussions were certainly constructive in terms of how we've been combating that, but it was something that certainly came up. And the other challenge I would say is retailers are certainly still dealing with some of the challenges on the labor, construction, and entitlement front, but some of the supply chain issues have certainly moderated, particularly as it relates to material and freight costs. But I would say overall, the sentiment was extremely positive. Stacy, the next slide. This slide shows a breakdown of the tenants that have been driving our leasing pipeline over the past year, led by operators in the service, restaurant space on the small shop side with value apparel, and some of the leading tenants in the open air space on the anchor front, like Target, Home Goods, Ulta, PetSmart, really leading a lot of that box activity. We were in front of all of these tenants on this page that had representatives in Las Vegas last week and continue to be encouraged from what we hear. That included TJX expanding their Sierra and HomeSense concepts into new markets in 24 and 25. Sprouts Farmers Market, David Gerstenhaber has done a great job of expanding in our portfolio, continuing to focus on expanding in their existing markets. And then operators like Barnes & Noble, they've done a great job revitalizing their stores, and they're looking to continue to invest in and expand their open air footprint. And finally, we continue to see great operators in the restaurant space that have been attracted to the suburbs. Many were focused on more entertainment-based locations previously, or central business districts. We touched on this trend a year ago, and it's certainly accelerated since then as we continue to see high quality, well-capitalized restaurant operators looking to expand in our portfolio because that's where they see their customer, and that's what they see their customer is demanding in the suburbs. Next slide, Stacy. That that trend is particularly evident in the outparcel program, which Tanya oversees, and we've had incredible success in over the past 7 years. You see the work that her and our teams throughout the company have done with 80 projects stabilized or in process over that time frame, with a similar pipeline of opportunities that we see out in the next several years. The demand for space in that category is the strongest. It's driving the highest rents in the portfolio. And the work our team across the company has done in freeing up those opportunities has really been paying off. Our anchor tenants are more receptive. The four of us on the screen often are getting a lot of these consents. And when we're talking to our anchor tenants, they not only see the traffic that a Starbucks or a Chick-fil-A or a Chipotle brings, they see their customer. And so they've been much more receptive in those discussions, and it's led to freeing up those opportunities. The other party that's been receptive is municipalities. They've been very accommodating in terms of adding density to our parking fields. They don't want to see large parking fields just empty. They want to see more activity. So that's something we've been able to work through with parking ratios and such. And it's been a great business. It's something that we remain incredibly focused on, and we continue to invest in. And it's also another opportunity in some of this disruption. When we take a Bed Bath box back, we take back 20, 30 years of restrictions on that space as well. So it's freeing up some opportunities there. So I would say overall, we were extremely encouraged by the activity that we had at the show, by the depth of tenant demands and tenants that are looking to grow their store counts. As you can imagine, we have a ton of follow-up coming out of the show. And so why don't I bring in the rest of the team here so that you can hear their thoughts and some of their takeaways before we open it up to the audience. Again, if you have a question, both on the screen, raise your hand, and we'll certainly get to you that hand raise icon, and then also use the chat function as well. So with that, why don't I turn it, Tanya, Laura, and David, to get each of your perspectives. You heard what I thought about the conference. What were your thoughts in terms of the mood, the general tone of your meetings compared to last year? One of the takeaways is that we head into this even with some macro challenges and thoughts of a potential consumer slowdown. Retailers remain focused on growing. But why don't you talk a little bit about that and what you heard from the show? Tanya, how about we start with you?
Sure. As you touched on, and what the slide indicated, the increased activity or continued increased activity as it relates to the drive-through, QSR, fast casual restaurants has become incredibly competitive. And it's really driving up rents for the drive-through spaces. That is one of the main focuses that really came out of the actual conference, was where we're developing these multi-tenant buildings, or where we have the opportunity to do one drive-through for whatever reason, the physical site or municipality, that we really have to determine what is the highest and best use, and we're able to drive rents that way. The only negative is we're so relationship focused, is that you have to tell some of our partnering retailers that they're not going to get that space. Laura and I are actually working on several of those right now in the North region, but we're busier than we ever have been.
It's certainly a challenge, but something that you all have gotten pretty good at navigating over the past couple of years, for sure. Laura, how about from your standpoint?
Absolutely, Brian. I concur with what you and Tanya have already shared. It was a tremendous show, and picking up on what Tanya's alluding to, I think what was different for me this year was the direct competition for the same space from multiple retailers, which we've seen that starting to build, especially at some of our higher profile redevelopment assets where we've made that investment, and the follow-on leasing has come to fruition. But I'm really seeing depth to that situation developing after this show. I had a broker say to me regarding one of the projects that Tanya just alluded to, well, what's it going to take? What's the number? My client needs that end cap. They need the drive-through. Tell me the number so that we can secure the location. And certainly having those types of conversations is new and refreshing, and certainly, as Tanya mentioned, puts us in the driver's seat in terms of the merchandising play, driving the highest and best use for the asset. It's a fun time to be on the landlord side and be in leasing. There's a lot of great opportunities to really add value to our real estate.
That's awesome, Laura. David, how about from your standpoint?
Yeah, thanks. Hey, everybody. Nothing earth-shatteringly different than what you've heard already, but the tone from my meetings was super positive. Most of them started with how can we find more deals in centers like yours? It seemed like a broken record, but almost every meeting I had, tenants were telling me that every time they travel markets around the country, they see Brixmor centers they want to be in. And this is driven by the continued transformation of our portfolio via the reinvestment, which is allowing us to attract better tenants. And, you know, we like to call this convention our Super Bowl, and I think we won this year.
That's great. So David, why don't we stick with you? Obviously going into their big focus this year was not only in the reinvestment projects that you and Laura mentioned, but also on some of that at-risk tenant spaces. Disruptions picked up as expected earlier this year. Can you talk about maybe the types of tenants and conversations that you and the team were having on the Bed Bath, David's Bridal, Tuesday Morning spaces, and how tenants are approaching some of that inventory?
Yeah, sure. So the breadth of categories for those bankrupt spaces is very wide. I'd say the most active players on the Bed Bath boxes are the off-price guys like Ross, Burlington, TJ, and specialty grocers like Sprouts and Aldi. And then with the Tuesday Mornings and David's Bridals, which fall generally in the 10,000 square foot range, the most active players are gen merchandise like Top Shelf and Five Below. And then there's a wide range of categories, again, pet goods, health and beauty, boutique fitness, books, like you mentioned with Barnes and Noble, home decor, and even shoes and apparel with the continued trend of retailers coming out of the mall and seeking open air strip.
Great. Laura, anything to add from your end on some of the troubled tenant space? You don't have as much of it in your specific portfolio. I know you have a few Tuesday mornings.
I have the Tuesday mornings, that sort of 10,000 square foot footprint. And yes, echoing what David said, the demand is there. I mean, we have LOIs on all the Tuesday morning spaces that I have in my portion of the portfolio. And in some cases, multiple LOIs deep. So we'll be wading through highest and best use and figuring out what the right merchandising play is for that particular asset.
That's great. Why don't we take one from the audience here? Greg, I see you have your hand raised.
Yeah, thanks, Brian. So I appreciate the commentary on this broad-based tenant demand that we're hearing and this focus that tenants have on 2024, 2025 opening plans. Just hoping you can give us some measure of the demand as it compares to what you saw in 2020 for 2022 openings and 2023 openings, both from a breadth of demand standpoint and the volume of openings that we're maybe expecting to see. You may have to imagine that occupancy increases we've seen over the last few years, with record occupancy on the portfolio, it gets increasingly difficult to replicate that given less vacancy to backfill.
Yeah, well, I first start, and then I'd love to hear some from the team as well. So in terms of open to buy from public company retailers, those retailers that have been expanding showed those signs of dialing it back. And whether those are in the off-price category, specialty grocery, general merchandise, that Tuesday morning size range that you would see Five Below, Skechers, and Pop Shelf in. It's not like they came to the booth and said, hey guys, we're pulled back. I mean, obviously as occupancy gets higher, like the overall in terms of productivity, volume, you don't have as much space to lease. Having said that, what you are seeing is a tenant like a Five Below who sits down and says, guys, we got to open 200 stores. How do we get ahead of the next one? And how can we negotiate with you proactively on some of this space that we're going to spec some time on, right? We're going to put some resources around to be able to do that. So from that perspective, there wasn't one conversation that I was in with any of the tenants that are expanding that said, hey guys, we're dialing it back. It was more of how can we get creative and how can we get flexible to ensure that we hit our store opening plans. Jim, do you have something to?
Yeah, I mean, I would just,
add on that?
one of the things that I think is particularly healthy about the demand is if you think about it in the context of retailer guidance. I think most retailers have come out a bit more conservatively on 23, and yet, they're looking through potential softening consumer demand and thinking about 24 and 25 with very aggressive store opening plans. And I think a lot of that's driven by the experience the store provides and the role it plays in a multi-channel strategy. So, when you have your core retailers almost to a person, continuing robust new store opening pipelines, and then you're seeing new concepts coming into the space, as well as mall native retailers coming into the space. It's allowing us to drive rents and spreads and growth in that respect as well. So, it's very encouraging from my standpoint to see the breadth of demand and retailers competing for space. I mean, that one quote was pretty funny. It's great to be a landlord right now. That's right. And we're also not dealing with an environment where there's any new supply to speak of coming in, nor do I expect there to be any new supply for the coming years, given where the capital markets are. So it's very encouraging. And, as I mentioned, we're really doing business now for 24 and 25.
If I could just follow up. So this level of tenant demand that you're seeing, it's something that we've heard from public and private landlords alike, just tremendous tenant demand for space. How do we think about the Brixmor portfolio, and how does it stand out among peers for, whether that's sustained demand or occupancy retention during, if there is a potential downturn, or what we've seen on some of the discretionary commentary on discretionary spend, whether that has an impact on tenant demand going forward? How does the Brixmor portfolio stand out?
I think you've seen it in our numbers. Every observable metric, whether it's absolute levels of productivity, which we lead in, whether it's spreads, which we lead in, whether it's the accretive reinvestment, that leads to triggers where, we benefit from attractive rent basis. So as I like to say, that rent basis allows us to outperform in a slightly down market and a flat market. And in a rising rate environment, it truly significantly outperform. And you see it in terms of the market share that we're grabbing of these retailers' expansion. And you're getting it in the feedback that we're getting from retailers who, as Brian alluded to, recognize the transformation of this portfolio, the markets that we're in, and the white space that they have to grow in. It's a great question, Greg, but it's in all the numbers. You see it in the productivity, you see it in the occupancy gain, you see it in the record rates we're driving, you see it in the yields that we're driving in terms of our reinvestment pipeline. So it's very encouraging. And really, our shadow supply right now are the Bed Bath boxes and the boxes recaptured through bankruptcy. So to have a very attractive rent basis as we do in that product that we're getting back means that we can actually make money through the disruption, even with downtime.
Great, thank you.
Thanks, Greg. Why don't we go to Anthony?
Thanks, Brian. It's a question on the bankrupt spaces that are coming back to you. Given the competition, how important is it for you to maybe bid on those spaces in order to make sure you control them and control the merchandising as they are released?
Yeah, Anthony, it's a great question. It's one of the reasons we were very intentional with Bed Bath even ahead of this. We proactively took back 4 locations that we structured last year. We've already leased 2 of those. We're at lease on the others, and we continue to see great demand across the board. We're going to be prepared at the auction, but we're going to be disciplined in terms of bidding on that space. Our team, as you see on the screen here and across the country, we have a good understanding of who wants to be in those locations, and we're in discussions with many of those retailers today. You have seen retailers that have been somewhat aggressive. You look at Five Below, who took out, I think, 30 Tuesday mornings. Burlington's already took out 15 Bed Baths. I think it does speak to the demand that's out there overall. I think we're going to be in position to make sure that we control our destiny, but also remain disciplined there as we go through the process.
Thanks. And maybe one more in terms of the out parcel development. It seems like there's pretty good returns there. How many more of those opportunities are there in the portfolio, you think?
Yeah, I mean, we see runway. I think like we said, and I'd love Tanya to chime in here. You know, we've either been in process or stabilized 80 of those. We see a similar volume of those opportunities out the next several years. And the interesting thing about that is kind of what I had talked about in terms of some of those opportunities are opening up when you get the spaces back. I mean, if you looked at our total shadow out parcel pipeline, it's well in excess of that. It might take some time to ultimately be able to reconfigure a box, be able to get the space back. Because while we have had a lot of tenants that have been receptive, getting the approvals and getting those things do take some time. And so like a project that Laura's got in Doylestown, PA, where we're backfilling a former discount retailer with a Whole Foods, a Barnes & Noble. We're going to take an old Regal down and we're going to be able to backfill that with out parcel tenants and do that accretively. That came as a result of that disruption. And so you're going to see more of those opportunities, but at a minimum, you see a similar pipeline of what we've been able to put in place here over the last 7 years.
And one thing,
anything more to add?
oh, I'm sorry.
Okay, sorry, Jim.
No, I was just going to say, you know, we talked a bit about this during the pandemic, but you're seeing the fruits of our efforts during the pandemic pay out here as well. And that when we were giving some of these tenants deferrals, we were lifting restrictions on the ability to add out parcels. So, you know, you'd like to add them everywhere immediately, but you've got these pesky things called leases that can control the rights and control the timing. So we very opportunistically look at these bankruptcies or look at things like the downtime that we had during the pandemic as opportunities to further encumber our sites. And our shadow pipeline's far greater than what we've already executed upon.
Great, thank you.
Thanks, Anthony. Why don't we head to Todd?
All right, thanks. Yeah. So I guess Brian and team, you know, your comments, you know, suggest that leasing demand's quite strong today and quite strong compared to prior cycles, it sounds, but the economy is slowing and consumer spending is normalizing a bit. How durable do you feel that the demand is today? Is there a point at which, you know, retailers begin pulling back and demand thins out a bit? What would you be looking for as a sign that tenants might begin to pull back a bit?
Yeah, let me take the last part first. I mean, typically what you would see is you'd see higher percentage of just overall move-outs. We haven't seen that. You would see tenants that are coming back trying to negotiate renewal rates or rental rates. We haven't seen that. We're signing our renewals at the highest rates that we have, I think, in 7.5 years, among the highest we've ever had. As a company, you'd start to see some of that small shop distress, which we haven't had. I think some of the issues from a financing standpoint are actually helping us a bit. We talked about on prior calls the work that we've done from a credit underwriting standpoint, the leasing team partnering with Angela's team to better understand the tenants that we're doing business with. And we're seeing very well capitalized franchisees that are still looking for space. We talked to a franchisor at the conference who said, I have more franchisees than I have territories to sell. And those franchisees are more well capitalized than they were a few years ago. And I come back to just from a demand, this is something we're certainly laser focused on. We see the same headlines. We're asking the same questions. I think it comes back to what Jim talked about is the store is still the most profitable way to deliver goods to the consumer. We are still at historic low supply in terms of available open air space. And even with some of this supply coming online, you're seeing tenants that are jumping at it. You're seeing tenants that we're negotiating with. You're seeing tenants that are bidding for this space very proactively. So it's something that we continue to remain laser focused on, but it's like a self-fulfilling prophecy. We're putting better tenants in. They drive more traffic. More tenants want to stay, and you bring and you're able to build off of that and create a better co-tenancy and merchandising mix. So we feel pretty good about it. We're encouraged, but it's something that obviously we still continue to stay pretty focused on.
Angela?
Jim, Angela?
Yeah, I was just going to say, you know, if you think about sort of the demand you heard from everybody on the Brixmor team today in terms of, you know, the conference really focusing on new store openings in 2024 and 2025, I would say consistently in all the meetings that I sat in on, you are talking to retailers who are fully anticipating a little bit of a slowdown in the consumer, a normalization of some of the pandemic sales trends, things like that. That's all in retailers' base case assumptions right now. And yet the demand we're talking about and what we really talked to tenants about at the conference was about 2024 and 2025, taking all of that into account. So the demand you're seeing, I think, does fully reflect, a slowdown in the consumer and normalization of some of those trends. But outside of very specific concepts that might have had operational challenges or balance sheet challenges across the board, you're hearing really robust demand as tenants and specific categories look to continue to take market share from some of the older formats and older retail formats and older retailer formats.
Okay.
Angela, just before I go to the follow-up real quick, just wanted to follow up with Angela. Like, this is your opportunity, Angela. You sit in all these meetings every year, both in Vegas and New York. What was your read in terms of the financial health, the wherewithal of those tenants looking to expand as well?
Yeah, I think about the big picture categories in terms of expansion. The grocers really across the board are in very strong, financial condition. The off-price retailers, again, across the board are in very strong financial condition. In addition to a lot of the specialty retailers you've heard the team throughout today, the Five Belows and Ultas and many of those retailers. You have a lot of retailers with balance sheets in great shape, but they're also generating a tremendous amount of free cash flow, in most of the national retail platforms that have those big open to buy plans over the next several years. And so despite the fact that, yes, everyone's cost of capital has certainly changed, you're talking to retailers that have a significant amount of internally generated free cash flow to put to work. And again, taking into account a more bumpy or disrupted macroeconomic environment, they still feel really good about their ability to continue to grow and to continue to take market share, again, sort of from other formats. There were only, probably 2 or 3 meetings I sat in and or even heard about in our booth at the conference where retailers had adjusted down, the open to buys they were looking at over the next couple of years. And again, because of pretty specific issues as it relates to operational challenges or missteps or specific kind of balance sheet issues. But what I did hear, which was sort of incremental for me and a little bit new relative to what I'd heard from retailers before, is a number of retailers coming in and saying, this is my open to buy. But the open to buy is very much informed about what I think I can actually get done, what we're promising externally, and everything else. And I sat in on one meeting, one of our retailers with a very healthy open to buy, something like 100 stores next year, who said, we would do 150 if we thought we could find the boxes, right? And so, it sort of ties back into an earlier question about, that how sticky how durable is that demand? I think what you're hearing is, there's sort of a shadow pipeline above what retailers are talking about publicly in terms of the open to buy plans and demand. And it's sort of that amount plus in many cases from our retailers, which is again, contributing to that sense that there's just a tremendous amount of demand on individual spaces as we continue to execute our plans over the next few years.
Okay. And then,
Yeah,
I just had one more. I guess, there was a lot of discussion at the conference around, transactions. And it seems there's a little bit more product coming to market, some single assets, some portfolios. Can you talk a little bit about Brixmor's appetite today and just discuss whether you are seeing more opportunities begin to surface and whether pricing or price indications have adjusted a little bit more in your favor?
Yeah, we're actively involved in discussions on the transaction front, but I would still say not a lot's trading. So there's still a gap between seller expectation and where at least we as a disciplined capital allocator believe returns should be. And we think we'll be rewarded by being patient, but we are encouraged, particularly with some of the conversations that we're having with some of the private platforms who by definition rely on asset level financing. The banks are getting tougher. It's just a fact of life. Many of you work at banks, you hear it, you understand what the credit folks are saying as it relates to at-risk capital and how precious it is. And so it's really impacting a lot of the private owners, not just with respect to their existing assets, but also with respect to any sort of ground up plans they might have. They're having a difficult time figuring out how to capitalize some of those opportunities. So I think if we are patient, it's going to come our way. I'm not saying it's going to happen this quarter or next quarter, but the winds are clearly blowing in our direction. And the wall of maturities that's coming also makes us very encouraged. So not a lot's traded. There's still a closing of the gap that needs to occur. But when we believe it's opportune, we'll step in.
Thanks, Jim. Craig, why don't we go to you?
Yeah, thanks, guys. Angela, you talked about the credit profiles being better for a lot of these tenants and a lot of good demand, but it feels like a lot of the discussions around the national guys with bigger balance sheets, the larger franchises, just given the opportunity you guys have in the shop portfolio. I mean, what have the conversations been like with some smaller tenants who maybe rely more on the local regional banks post SVB? Are you guys seeing any issues with business formation, capital raising on this front that could, limit the upside a little bit beyond the backfills of some of the bigger bankrupt spaces in the anchor boxes?
Yeah, I'll start briefly, and then I'll kick it over to Brian and team to talk more specifically about what we're seeing at a local level. Obviously, the conference is very much oriented towards larger national, large regional players, franchisors, things like that. Brian made a really important comment earlier about just the strength of franchisors and the strength of their franchisees, sort of balance sheet capacity, how many of those franchisees are now, really sort of large companies in their own regard now anyway, right? So we are seeing that on the small shop side, that demands in kind of quick service restaurants and a lot of services, salons, medical, a lot of those kind of concepts. So that part of the tendency has gotten better, and the tone around those types of retailers was very consistent with everything you've heard on this call at the conference. All I can say, and really I want the team to speak to it, but all I can say is, in terms of what we're seeing show up in lease committee every week, from the smaller, kind of more local mom and pop retailers, does not indicate, any slowdown in the activity we're seeing there. And again, Brixmor is in sort of a unique position given how much work has been done on the portfolio, the anchor side, and portfolio transformation over the last several years. We are sort of leasing into centers that have really improved from a look and feel and traffic generation capacity and all of that. So we continue to see a lot of those, that follow-on leasing benefit that you hear Jim talk about a lot, continue to show up in leasing committee every week. But I can't say that we've seen any slowdown. And as Brian also mentioned earlier, we aren't seeing move-outs pick up in that segment of the tenancy either. Brian?
Yeah, you did a great job hitting that, Angela. The only thing I would say, just double down on, is just the strength of the portfolio and the quality of the operators. And frankly, how over the last 3 years, I mean, the pandemic, certainly there were tenants on the small shop side that weren't able to make it through. What that did create, though, is much more well-capitalized multi-unit operators, both on the national and local front, that are coming in and looking for second-generation opportunities, more well-capitalized restaurant concepts. So we're certainly seeing that on the small shop space. And just again, back to kind of Todd's question, it's something that we're focused on and looking at. I guess the other thing I would mention, we did talk to one franchisor who we asked this similar question: are your franchisees having issues from a financing standpoint? And they've had lending institutions that have helped franchise concepts, and they were paying a bit more from a rate perspective previously, so they were used to doing that to some extent. But as we think about the strength of franchisees overall and the quality of tenants that we're talking to, both on the local and national front, we feel like we're in a good position today, but it's something that we're certainly keeping a close eye on.
And then just a follow-up. I know at the conference we heard a lot about rising OpEx with insurance in some regions really kind of pushing the expense side up, and everyone was talking about that, and you guys did as well. Tenants are willing to pay the freight for some of these better spaces. But I'm just kind of curious too, as your cost of capital has gotten higher, right? TIs are more expensive now as well. Are tenants willing to pay that extra rent growth to where you guys are able to keep the returns consistent, what you've had the last couple of years? Or are you guys seeing kind of those incremental returns on capital come down because tenants can't, swallow the OpEx increases plus the commensurate market rent increases to kind of keep you guys whole on that side of things?
maybe I'll start and Angela, kick it over to you, but we remain very pleased with the returns we continue to generate, even with the pressure of additional OpEx and frankly, higher construction costs, longer entitlement timeframes. We're still able to generate yields well in excess of a higher cost of capital. We've always made our investment decisions, Craig, with the view that capital costs are going to be higher in the future than they are today. And that discipline, I think, has served us well. The other thing I would highlight is that, as you mentioned, costs like insurance or security or other areas where you're seeing some inflation, having scale really matters. We see it, in fact, when we underwrite new acquisitions. We have the ability to drive synergies in the margin given our scale and size. And the last thing I'd comment on as it relates to that is I also believe we're getting larger market share with the tenants who are growing because of our scale, track record, and size. They know that we're going to deliver that box on time, on budget, and that relationship and trust that's been built through our execution is incredibly valuable as you go through periods of time like this, because as they're thinking about John Q or Jane Q, private landlord, these are bigger questions that they've got to address and answer. And as I like to say, the public platforms really don't compete with each other. We own 10% of the available space. We're competing typically with a private, less well-capitalized, less scale-intensive platform. So as you go through a period of time like this, our scale and efficiencies are a huge advantage as well as our track record.
Yeah, I mean, I don't have a ton to add in terms of what Jim just said. I think, at the end of the day, this is an occupancy cost driven business, right? In terms of what retailers will pay from a sales perspective, and sales are up materially over the last few years. So while you're seeing inflation in costs, you're seeing inflation in capital costs and OpEx, you've seen inflation in sales. And so that's why when you look at our net effective rent disclosure, we continue to hold that in line or continue to grow it. The spreads have been very consistent. The nominal ABR dollars continue to inflate as well. So yes, I think we are continuing to keep pace with what we're seeing on the cost side. None of which is to say that we and the retailers aren't laser focused on continuing to control those costs, right? And doing everything we can. And I sat in on a number of meetings in Las Vegas that we're really focused around, again, as we're trying to open a lot of new stores over the next few years. and we're doing things like trying to quickly capitalize on some of the disruption in the market in terms of bankruptcy space. What can we do, with respect to our prototype to control costs, to be more flexible about the existing conditions of the space, to try to get stores open as quickly as possible. And so those conversations are ongoing. I think we're very much aligned with the retailers and trying to make sure we appropriately manage those costs. But where you have costs, especially on the capital side, that have continued to grow, despite everyone's efforts to value engineer and to control those costs, you're certainly seeing the rents inflate accordingly.
Great, thanks. Why don't, before I give it to the audience, I just want to circle back with the team here and maybe get a sense of any new retailers or concepts, categories that you were really excited about coming out of the show. Laura, why don't we start with you?
Sure. Thanks, Brian. Yes, there's definitely some new concepts or expanding, growing concepts that are coming into Brixmor's portfolio at this time. One is Honeygrow, which is a Philadelphia-based concept. They've grown to 31 locations. We're working on a deal with them now. In one of our redevelopment assets in our meeting in Las Vegas yielded interest in 3 additional properties that we're going to explore. So that's an exciting one in the QSR category. We signed a lease with Veg, Veterinary Emergency Group, in our portfolio, and likewise met with them at the show, and they're interested in an additional opportunity in my portion of the portfolio. 6,000 square foot operator, fills a nice niche in a lot of our centers and takes out a fairly large footprint. We have renewed discussions. We certainly have Bath and Body Works in the portfolio, but that's a mall tenant that we're seeing increasingly grow their footprint in open air. And I have several of my redevelopment properties, one that we're at LOI with now, and a second one where we're expecting an LOI out of the show. So overall, good traction with a lot of concepts that are probably underrepresented in the portfolio or not yet there, and we'll be expanding post-show and as we go forward as their operating formats shift and they focus on the type of real estate that we have.
Great. Thanks, Laura. Tanya, how about from you?
Yeah, what you're seeing, I think, in the restaurant category is diversification for growth. How can they add concepts, new brands, or a lot of white space from regional tenants such as Whataburger, Raising Cane's, that are essentially open to expanding in almost every state now. They continue to open up new markets. Those are ground leases where the tenant takes on most of the risk, so the capital is low, their credit is solid. They are private companies, but a lot of white space from them across our portfolio. New concepts, Buffalo Wild Wings, they rolled out, it's probably been 2 years now, a Buffalo Wild Wings to go concept. It's essentially just wings. So we have a lot of white space with them as well. Piccolo Buco, a new concept from Cooper's Hawk, is a higher end wine focused, I'd say more pizza casual concept that we just signed a lease with in Naperville at a shopping center redevelopment we're doing there. AZ Pet, similar to the other concept that Laura was talking about, is a concept that was purchased by ADMI, which is Aspen Dental, and they're going to roll that out nationally. And last one I'd probably touch on is Live Nation. Their customer counts are up for concerts, and they're trying to determine how they can expand on that. A quote that they had was that their fan base enjoys live experiences more than any other leisure activity. And so they're looking at potentially smaller amphitheater venues, acre to an acre and a half, and suburban markets. So we're right now combing through our portfolio to see, where do we have that opportunity? So those were some of the more exciting ones that I think you'll actually see something come out of it in the next 12 to 24 months at the latest.
Yeah, I thought that was really cool on the Live Nation feedback that you had. David, how about from you?
Yeah, I'd say for me, what's really exciting is the experiential category, because we're continuing to see new concepts come out of that. One of them is Level 99, which is, you really have to go there to experience it to understand it, but it's a social entertainment concept. It's experiencing wild success, way beyond their imagination. It's an initial location in Boston. They're looking to roll this out across the Northeast and more of the country. It's basically 40,000 square feet of physical and mental challenges with all these themed rooms and competitive arena games. There's also Pop Stroke. I know we have some golfers out there. This is Tiger Woods' dine, putt, drink concept. Personally, super excited to get one of those in my portfolio. And there's also exciting concepts emerging within the established retailers like Dick's. Brian mentioned this before. They rolled out House of Sports, which has been a huge success. It's a 100,000 square foot box with a 20,000 square foot outdoor field concept. It has a rock wall component, golf hitting bays, outdoor turf field where they get to engage with the community. They do sporting events like quarterback clinics and hockey tournaments and the like. And then Foot Locker is rolling out a concept called Power X, which is a large format Foot Locker. It actually has an indoor half-court basketball court in it, and several other experiences available within the box where they're driving community engagement. So on that front, it's been very encouraging.
Great, David. Yeah, I thought the Dick's meeting itself, there were a lot of kind of key takeaways from that, but primarily just how many flexible different formats they have and their focus on expansion. Thanks. Why don't we head back to the audience? Flores, I think you're up next.
Thanks, Brian. So my question was, I'm hearing you guys talk about the supply demand balance and how you have gotten basically the negotiating leverage over your tenants. And by the way, it's not that dissimilar from all of your peers who are talking about the same sort of things. Can you maybe touch upon obviously one way we can see that is rate, the rents that you're able to get, and you've been driving your rents, particularly your new spreads have been as you pointed out near the top of the sector for a number of years now. But talk about some of the other elements, and how focused are you, Brian? We've been talking about this for a while, but things like fixed rent bumps, driving the total growth, being able to limit the amount of term on a lease, particularly for some of these anchor tenants, so they don't get 30 years at fairly low rents, because rents tend to rise by significantly more than your rent bumps for those anchors, and being able to mark your leases back to market, and maybe touch upon something which I'm sure is dear to Angela's heart as well, which is the capital and the TIs. And because if you're seeing demand, multiple tenants fight for demand, does that allow you to reduce your TI spend going forward, or should we expect that TIs are going to stay relatively flat? If you can touch upon a couple of those things, that'd be great.
Yeah, sure. Well, I think you highlighted a few things. You are seeing the competition come through in rates. You're seeing in new rates. You're also seeing it in terms of the work that we've done in the portfolio and the lack of options for tenants to move, both in the retention rate and, again, one of the highest renewal spreads that we've ever had. In terms of what we look at in leases, I mean, outside of economics, we're focused on flexibility. So from the economic standpoint, we certainly have been driving higher annual bumps. In the first quarter, 100% of our leases had growth over the term. We've been able to push higher annual growth rates, certainly more with small shop tenants than we've gotten with anchors. Although, to your point, the traditional structure has changed. We just had an anchor tenant, one of our largest tenants, who was typically used to 25 years of term, 3 options after a 10-year term. We got that down to 2, right? Because there was competition on the space. Where they might have been focused primarily on 10% growth in the past, we're getting that to 12.5 to 15. And it's because of the competition. So you're certainly seeing that. The other thing I'd point to on flexibility was whether it's the out parcels, whether it's the health and wellness uses, whether it's the ability to redevelop at a center, whether it's limiting co-tenancy or getting rid of it completely. Those are things that we've been able to really push for and been able to achieve across the portfolio. And as Angela said, we see these things in committee every week, and we're certainly highlighting them for the team. And a lot of that improvement is driven by the demand for space, but it's also driven by the work that the team's done across the portfolio. And look, costs are certainly up in a number of different ways. Having said that, our team has been very disciplined. As Angela mentioned, you can look at our growth in net effective rents. And the competition for space is also allowing us to go back to tenants. Sometimes, which we don't like to do, like when we've already kind of set and agreed to terms, we went back open book and said, look, here's what changed. You might have changed the scope. The municipality came back and said you had to make these tweaks to the site work. And you know what? They're coming back and saying, well, we'll make it work in rent. And these are well-capitalized operators that we feel really confident about their ability to offset some of those costs. So I'd say, look, across the board, the competition for space is helping improve a lot of those metrics, but we're not simply focused on the going in rate. It's all the other improvement that we can make throughout the terms of the lease.
Can I just to emphasize the point Brian's making, I think, and sort of bring together something he mentioned earlier as well. But when you really think about the economics involved in some of these anchors bidding on leases in bankruptcy, right? They're going in, maybe the rent is at market or a little bit below market, but they're stepping in midstream, right? They're not getting the full term they're typically used to, and they're putting all of their own capital into the space. And all of this is done to really just secure certainty of execution, right? To get access to the space, as Brian mentioned earlier. So I think that's a good third-party data point that really verifies everything you've heard the team say in terms of the competitiveness in the environment and the degree to which tenants will be flexible on a wide variety of terms to ensure that they can actually meet their store opening plans over the next several years.
And if I could maybe follow up, and obviously you guys have a huge portfolio, national portfolio. You have clusters of significant centers in New York and Philly in particular. Are you seeing regional differences in tenant demand, and also maybe talk about where you do have clusters? Are you able to drive better economics? What are the benefits of clustering properties and in your view, and how does that manifest itself in terms of NOI growth?
Floris, I'll take first, we're pleased by the growth we're seeing across really all the regions. You know, the rate of recovery coming out of the pandemic varied, with markets like the Northeast and California being slower to recover. But we've seen that differential all but erase. And, you know, we're pleased by the breadth of demand that we have across the portfolio. And the importance of clustering is, yes, you get efficiencies as you locate assets near each other, but you also are able to drive rent because you're seeing more of the overall aggregate tenant demand that's trying to be in a particular market, which allows you to be tougher in the negotiation of the rent and drive that extra buck or so a foot. So, you know, we're seeing real benefit from that as well against a backdrop of improved tenant demand.
I'd like to add also, just real quickly, as it relates to sort of that West Coast and the Northeast, where labor costs were an issue prior to COVID and then coming out of COVID. We're actually seeing that now be offset with the digital capital investment from the fast casual restaurants. So the efficiencies that they have now with their mobile app ordering, their mobile ordering within the store, and now you'll start to see there's a lot of AI being introduced through fast casual, through their ordering and drive-through. So that's been able to offset labor. So they're opening up those markets where they were slow to expand, you know, pre-COVID. So that's actually a positive coming out of the last 2 years.
That's a great point, Tanya. And maybe just before we jump off this, Laura oversees the portfolio for the largest shopping center owner in the Philadelphia market. Maybe she can speak to some of the clustering benefits that she's seen as we've grown that portfolio and we've invested in it.
Absolutely, Brian. It's certainly, there's a lot of value to be had in controlling a node, because if a retailer wants to be there, they have to come through you. I mean, I'm sitting right now in our office at Plymouth Square across from White Marsh, which is another center we own. And I had at least 3 meetings in Vegas. We have a Salad Works here with Term, but it's, you know, there are other concepts that would love to be in this project. And multiple people said to me, what do you have at Plymouth Square? What do you have across the street? Get me into the market. Like, let me know when something, if anybody trips up in rent or anything opens up, I need to be at that intersection, and you've got the intersection. So please tell us when you have an availability. And I think that's an illustration of why the clustering is valuable and what it can do for you in terms of both driving rate and opportunity. As we look at that pipeline, I mean, leases ultimately roll. You're going to have new opportunities to bring other retailers in, and then pricing power and merchandising as well.
That's great. Thanks, Laura. Thanks, Floris. Why don't we head to Alex?
Morning. Thank you. So just a few questions. First, just big picture on the banks. Are you guys hearing of any of your tenants expressing concern about banks pulling back inventory financing for the fall? It's been a topic that I've heard some investors more on the generalist side bring up in some recent meetings. And I wasn't sure if you guys are seeing anything like that or having any concerns about the ability for the tenants to procure enough inventory for the fall, given bank financing, factoring, et cetera.
It didn't come up, and it hasn't come up in any of our tenant meetings that I've sat in. We've really been focused from a lending perspective on the banks, as to our comments earlier related to our retailers, particularly local, more regional retailers, and their ability to secure financing, and something that we're looking for cracks on. But I haven't heard much of that. I don't know if anybody else on the screen has.
Okay, that's a good thing. The next is, you guys talked a lot about the demand for drive-throughs and how, you have relationship tenants. Sometimes you have to have hard conversations. If you could just expand on that, are you actually sort of kicking out tenants or taking away drive-throughs from existing tenants to replace with more productive tenants? Are you kicking out, long-term relationship tenants because the new tenants are more productive? Or how are you juggling long-standing good relationship tenants with the desire that they're more productive tenants you want in, higher paying, and obviously there are only so many end caps and drive-throughs that you can have in your properties?
Let me just start. Have Tanya, David, really everybody chime in. As the team alluded to earlier, it's something that we are certainly juggling. I think that one of the things that we're doing to, particularly in centers that we're reinvesting in as it relates to those out parcel opportunities, is communicating that to tenants, being incredibly transparent. And where we've had existing operators, we want them that are successful, we want them to reinvest too. You look at some of the tear down fast food guys that we've done across the portfolio that are literally tearing down their buildings with no downtime in rent, and oftentimes doubling it to stay at market because they don't want to lose that Taco Bell, they don't want to lose the Wendy's. And from a use perspective, depending on the market, they're putting a better presentation there as well. So it's certainly been a challenge in terms of both the competition for some of those drive-throughs, Alex, as well as how we're working with existing tenants. But if we have a great tenant that's been in there, they're certainly, what we're seeing generally is they're reinvesting with us and committing to the site long term and actually performing better. So Tanya, I don't know if you or David or Laura have anything to add.
I think you nailed it there. I mean, a perfect example is Northeast Plaza redevelopment project in Metro Atlanta, where we have several out parcels that we have the opportunity to re-tenant all of them to improve both the image of the shopping center, and most of the existing tenants that are long-term national tenants we partner with, they're doing exactly what Ryan just said. They're agreeing to scrape and rebuild. They put the capital into it, and they also increase their rent. We try to go to them first. I mean, unless there's some sort of credit issue or, of that nature, but we really do try to maintain those first before going to market.
Okay, and just the final thing, the economics of new supply, clearly there's, the challenge of getting the land assemblage, there's community pushback on entitlements, but, given the demand that you guys have spoken about and others, how far do you think we are away from meaningful new supply, or the combination of just site availability, entitlements, et cetera, means that any new supply that will come is not going to look like what it was in the 2000s and the 90s, where you had these massive waves? It's really probably just going to remain small and, one-offs rather than large, assembly amounts that are coming online.
I think in addition to the constraints you mentioned, the biggest constraint right now is the financing and credit markets, where these banks have to set aside 100% of the capital for construction and development loans. So you can imagine how popular those are within the banks. They're not. And, we had discussions with some of our larger box tenants who were trying to, because there's not any sort of available supply of boxes in the 100 to 120,000 square foot range to grow in a particular market, their only option is ground up development, and they're really having a hard time finding local developers to do that for them. And why? Because of the credit market. So that's not something that I see abating anytime soon. And then, Alex, you have the other issues that you just mentioned, entitling the land, permitting, everything else, tying up the land. So, it's hard to envision a return to the mid 2000s go-go supply for the next 3 to 4 years. Could something change and put us in a position where you see a big growth in supply? Sure, but it's going to be lagged out there.
Great, thanks, Jim. Thanks, Alex. Just before I go to Mike, just remind everybody of the chat function here in the Q&A. If you do want to ask a question and you're not on the screen, please feel free to do so. But with that, Mike, why don't we go to you?
Yeah, just have a quick one on maybe tying some numbers together on the out parcel program, excuse me. I think you had about 69 or so that you talked about, where you had about a 14 or 15% return on them. The ones in process today are about a sub 10% return, I think about 9%. Can you just talk about, some of the differences considering interest rate levels are higher, return expectations are higher today?
Maybe I'll hit that at the start and let Tanya's team address it. Really, it's the mix of those projects that are in that, what's currently underway. As we look out into our shadow pipeline, we see plenty of opportunities still in those low to mid-teens returns. So it's just really an issue of mix. And, even with what we have underway at those 9% returns, even in this market, the value being created with higher costs of capital is still huge and significant. But when you look at that shadow pipeline of what we have beyond the 10 or so underway, it's well over the 80 that we've done. We're encouraged by what we see, and particularly the inflation in rents. One of the disciplines that we, I think have done a pretty good job of, and Angela mentioned this, is driving rate. And Alex, you talked about how do we manage the tenant conflicts? You drive rate. If the tenant really wants to be in that particular location, they'll pay $80 a foot. And so, that is something that we find very encouraging. And Tanya and team have done a phenomenal job of leading our effort there.
What's an example of, I guess, a project where you would have a lower return on an out parcel project? What are like some of the attributes of something like that?
I mean, it really depends. Sometimes you can have a multi-unit parcel with higher development costs, more that you're putting in for the tenant space that can be done at that particular center, to a ground lease where all you're really doing is prepping the site and you're getting a much higher return because you're not putting as much capital to work there. Tanya?
Yeah, absolutely. The build to suit scenarios that we're willing to do for our high credit tenants like Chipotle and Starbucks, those returns are pinched a little bit, but conversely, we're able to do them typically or often on an end cap of a multi-tenant building. So we're densifying the site versus a single tenant ground lease, which would have a much higher return, lower cost.
Got it. Okay, thank you.
Thanks, Mike. Good question. Why don't we go to Caesar?
Hello, thanks for taking our questions. I'm calling on behalf of Dory Kesten, who could not participate in the call this morning. My question will be on the drive-thrus, and I think it's pretty clear that drive-thrus are in high demand and they're highly valuable. I think you mentioned that oftentimes you can achieve premium rent on those. Can you talk about the difference in cap rates for properties that come to market with a drive-through versus without a drive-through? And can you see an opportunity to acquire properties where you can add that drive-through to add value?
Tanya, you want to take that?
Yeah, I can somewhat. Honestly, Jim or Angela might be able to weigh in a little bit, but I've not seen cap rates swing with the having just because there's a drive-through there. It's still really predicated on the credit of the tenant, which often the Chick-fil-A's, the Whataburgers, the Raising Cane's, the Starbucks, they do still drive the lower cap rate because of their credit, and they do happen to have a drive-through. But if a moderate, tenant adds a drive-through, I don't think I've not seen that lower cap rate. It's really market driven and the credit of the tenant more so than drive-through.
Sorry, Angela, go ahead.
No, I was just gonna say, I think Tanya's totally right. It's also a question, it's credit, and it's a question of being able to drive a lot higher rent because there's a drive-through. That's where you're sort of getting the value accretion. To the extent we're looking at acquisitions and maybe we view it as, there's a potential in an out parcel or an end cap or something to add a drive-through that wasn't there from an underwriting perspective, right? That's going to influence how we see long-term returns at the center, which obviously has some impact on pricing. But that may be a situation where we think, again, we can just drive better outcomes than maybe, a private landlord who wasn't able to easily bring, all of that demand to bear on the asset. But it's less a question of cap rate exactly and more credit, just how much rent are you capping to begin with. Jim?
Yeah. If you look at some of our recent acquisitions like Bonita or Granada down in Florida or Brea in Southern California, a big component of highly visible growth is our ability to add out parcels and densify the site and take what is otherwise an unproductive piece of the parking lot and generate income from it, which we're increasingly able to do not only within our existing portfolio, but we look for in opportunities from an acquisition standpoint.
And the only thing I'd add to, just in terms of the drive-through discussions, we talked about when in Alex's question, approaching our existing tenants and talking to them about improving their footprint. It's not just tear downs. A lot of the things that Tanya has been working on, either adding a drive-through, maybe expanding a drive-through, right? The Chick-fil-A today is a lot different than a Chick-fil-A 20 years ago. And so what you get the opportunity to do, you get the opportunity to improve the rate. You also get the opportunity to, again, open the lease up, right? And look at a lot of the things that, whether there's restrictions, whether there's other things we want to improve upon. So that's something that also we're laser focused on. And sometimes this is an opportunity to do that with a tenant that might have 15 years of term left, right? So you're getting that pulled forward significantly. And that's something Tanya's been working through with a lot of our key out parcel partners.
Yep. Thanks for the detailed answers. And a different question, just given the backdrop of strong demand, can you talk about if there is a notable difference in demand for your centers that are anchored with a grocer versus those that are unanchored? And as well as any notable difference in demand among your top 20 MSAs versus the remaining MSAs?
You know, one of the things that we like about our portfolio is we have a mix. We're 70+% grocery anchored, but we're driving that demand pretty uniformly across the portfolio through our value-added reinvesting. And there are plenty of exciting co-tenants beyond grocery. Certainly, we drive a lot of interest in those grocery anchored centers, but you know, many of those centers may not have the space to accommodate junior anchors or larger co-tenants. So, for example, the off-price like to co-tenant with each other. And so, you know, in an off-price format, you may not even need a grocer to drive outsized performance. Brian?
I mean, Jim, you hit on it. I mean, I think the other thing that we're certainly seeing is in adding grocers is the flexibility within that grocer segment, whether that's Whole Foods looking to get a little bit smaller, Sprouts being more aggressive, Aldi and Lidl, Fresh Market. I mean, we've just seen the depth of grocer demand overall. So it has been a more opportunity for us to add a grocer. In particular, we look at the Sprouts example down at outside of Tampa that we did to backfill the Bed Bath box. So it's enabling us over the past few years because of the depth in the grocer demand to be more intentional about that. But to Jim's point, we have great centers of redevelopment that we were highlighting in suburban Chicago. It's got a fantastic amount of demand for a part of the center where there's no grocery at all. We've had, you know, you think about the demand that we've got at a place like Point Orlando. So it's certainly a mix. It's the diversification of the portfolio that overall we feel pretty good about.
I think given the natural level of grocer demand, you're going to see the relative percentage of what we own with grocery in it continue to accrete probably close to 80% as you think about naturally creating value in these centers and capitalizing on that demand. But you know, the keys to making money are attractive rent basis and flexibility. So do you have the ability to meet the demand to be in that particular node? Do you have the space? Do you have the co-tenancy? And importantly, do you have a rent basis that allows you to make money?
Thanks, Jim. Why don't we go to Elizabeth?
Hi there. Thanks for the time this morning. Just going back to the outer parcel development, because I know there's been a lot of talk on drive-throughs. Just curious if you're seeing more opportunities to add or enhance curbside pickup, and not just with grocers, but you know, even with an off-price or other categories. Just you know, interested to hear if any discussions with the retailers last week were, if you heard any new indications on how much more important this is. I know Target was probably the last major retailer to roll this out a few months ago.
Yeah, Elizabeth, it's a great question, and it's been a critical part of the store strategy for not just the grocers. So we had talked about prior to the pandemic being very intentional with the likes of Kroger and Walmart as they were expanding curbside pickup. What you saw coming out of the pandemic very quickly is more of our junior anchor retailers, the Ultas of the world, not off price as much. That's much more of kind of an in-store experience, but the likes of, Kohl's, the likes of DSW, some restaurants as well. They couldn't get a drive-through doing the Chipotle pickup that Chipotle certainly has. And we benefit from a very flexible footprint. We benefit from very large parking fields that even adding a space or two in a tenant's lease for Ulta is not going to impact our ability to develop a drive-through elsewhere. And I think retailers have become very accustomed to allowing each other to have a few spaces. I think the other thing is the consumers gotten used to it. I certainly wasn't going to curbside pickup, but because of the pandemic, you got used to going to Buy Buy Baby to pick things up and have people have things brought to the car. It's just another way to interact with the consumer. You can meet them at their house, you can meet them in the store, you can meet them in a curbside pickup where they're taking the most expensive part of the delivery out of the equation for you. So it's certainly something that we've been very accommodating with across the portfolio, and we're definitely seeing more tenants, more and more tenants that are asking for it.
And I think it's an element of the flexibility Brian referred to that continues to draw the mall native tenants to open air, right? Because it's that flexibility of format. It's the ability to give the customer proximity, convenience, access, to serve them how they want to be served. So it really informs a lot of the discussions, in terms of that relative level of demand to be in centers like ours where we can accommodate it.
Very helpful, thank you. And I guess just as a second question, it's good to kind of hear the consistency we've been hearing from you and your peers on it's great to be a landlord. Pricing power seems to be in your favor. And we're seeing more flexibility on the tenants end. So just curious, based on your conversations with retailers, what really remains the most contentious part of a lease agreement today? Is it really
Rent.
now more so the length?
Rent.
Still rent.
Yeah, I mean, the retailer wants to pay as little as possible and be as four-wall EBITDA possible, but they also recognize that there's competition for the space and that they're in an environment of inflating rents. And so, they're leveraging every possible advantage they can to fill their new store pipelines. But, really, once you get through rent, you sometimes have to deal with things like exclusives and some of the non-economic issues that Brian referred to, but almost across the board, whether it's co-tenancies, exclusives, rent bumps, options, et cetera, some of which have direct economic implications. This competitive dynamic is driving better and better outcomes for the landlords beyond just the rent. It is also giving this particular company, because of the strategy that we have executed, that has always been about value-added investment, additional tailwinds, additional leverage to continue to fill that pipeline and drive value. So, as I like to say, once we've beaten each other up on rent, we can get to agreement on the lease and get that tenant in occupancy as soon as possible, because there's one thing you're aligned on. You're not getting rent and they're not making sales until that store is open.
Great, thank you.
You bet.
Why don't we head to Connor?
Hi, thank you for the time. Touching a bit on the consumer side of things, coming out of ICSC, throughout your conversation with tenants, have you noticed any change in customer behavior, or maybe becoming more cost conscious or resilient, vice versa? And then maybe within there, any cross sections that could stand out between maybe the lower, middle, or higher end customer? Anything that stood out? Thanks.
Yeah, maybe I can take that and Brian, have you fill in. But, one of the things that we watch is our traffic at our centers. And we remain encouraged that the traffic at our centers continues to be positive year over year and positive relative, obviously, to the pandemic and pre-pandemic. So that's a constructive backdrop in terms of the actual traffic being driven to our centers. You've heard it on some of the retailer calls. Some retailers are seeing a shift in consumer behavior towards more non-discretionary items, or, part of that also, I think, is attributable, as you hear from retailers, to there's only so many TVs that you can buy, only so many of these larger durable goods that were purchased during the pandemic. You obviously would expect to see some abatement in that demand. But again, what we find particularly encouraging is that even with the moderation of consumer behavior, even with some of the more shifts that you're seeing to non-discretionary items, the retailers remain very profitable and also really focused on continuing to grow their store fleet. They're making decisions, as Angela was saying before, about 24 and 25. They're really looking through and appreciating the importance of the store to their overall strategy.
And that's, Jim, you hit on it, but the only thing I just add is the definition of what's becoming non-discretionary. If you think about wellness, right, today is much more non-discretionary in terms of demand for people both eating healthier, what we're seeing in terms of our overall gym memberships, both on the higher end and the low-cost providers. Beauty, right, if you look at Ulta's comps, has become much more of a non-discretionary item. So as you think about that, that's shifted a bit as well. And I think those are, as we look at the durability of the tenant base in our portfolio, it's much broader than I think it was the last few years.
Thanks. And maybe one quick one, and it could be too early to ask this, honestly, but that theme of traditionally big box tenants testing out smaller formats, maybe some time has passed. Are you seeing any change with retailers leaning in to that theme, or maybe backing off, or unchanged?
I'd love to, David, why don't you take this one?
Can you repeat it? I'm sorry, Connor. I heard the last one only.
It's the Connor, just on that. David, I'll start, then you can chime in. It's basically on the format piece. So I'd say it's going both ways, right? David highlighted tenants that are getting bigger, right? If you look at Dick's Sporting Goods, if you look at Target, they're looking at it and say, wow, we got to get bigger. And so they've been very successful in those formats. But then from a smaller standpoint, it's really opened up a wide range. You look at Macy's off-mall concept, what they're driving. They're looking at spaces anywhere from the low 20s to 40,000 square feet. Retailers that have been targets for that Tuesday morning space, the Five Below, the Skechers, the Top Shelf, they're going anywhere from trying to get down to 7,500 square feet to up to 14,000. To Angela's point earlier, depending on how much they can drive sales in the space. It's been really good for us as we've looked at, okay, if we want to backfill a space with a single user, or do we have two tenants like Ulta and Five Below who will pay much higher rents, but the cost will be a little bit more. So I think because of those splits, maybe the last few years, a lot of those 10, 12,000 square retailers have gotten very flexible. So in terms of what we're seeing, we've been pretty encouraged, but it's, as we see it, Connor, it's kind of on both ends of the spectrum. Some are getting a little bit bigger, some are getting smaller, but just generally we've seen tenants that have been much more flexible because they've had to be, right? If you think about to the earlier point of whether it's been construction costs, entitlements coming out of the pandemic to get stores open faster, we've been partnering with tenants to use a lot more existing conditions. It's kind of gotten them ready for some of the distressed space that's coming online. They're not doing it out of the goodness of their hearts. They're doing it because they need to get stores open, and it's the fastest way to do that. So from that perspective, folks have gotten a lot more flexible with the format. I don't see any hands on the screen. There was one question from Greg in the chat here. And Tanya, why don't you take this one? It was the preference really for multi-tenant versus single tenant out parcels, and maybe the any challenges in the entitlement process, as we're talking a lot about drive-throughs here. So maybe touch on that. And then as you think about, we've already hit on some of the investment opportunity. We think it's in excess. We see out in excess of what we've already achieved. But if you look at some of those near-term opportunities too.
Sure. It's really a balance between the shopping center and what we feel like we can get approved by the local municipality and the tenant demand for the actual outparcel space. We really marry the two together to find out what is really going to drive the highest return that we feel like that we can get entitled. And also, where's the risk mitigated the most? Sometimes these things take a very long time to get entitled. So we take that into consideration as well. So the schedule, the return, and what we feel like is most likely to get entitled. We have teams in every region that are equipped to handle this in-house, and really strong external partners as well. So we can vet that process pretty quickly so that we know when to either pivot or to make a decision to do multi-tenant versus ground lease, or to make that decision in the very beginning as to which is the best direction for us and for the asset to drive the highest return. I don't know, does that answer your question, or was there another part to it?
Nope, I think that pretty much covers it.
And credit, obviously credit. Sometimes the multi-tenant buildings, you may have a lot of interest, but it's, it might be from some local credit. We want to make sure that it truly is a good mix of national credit. So credit's in there as well. There you go, Angela. Forgot about that.
Appreciate it, Tanya.
Great, thanks. It doesn't look like we have any more questions either in the chat or on the screen. Oh, Alex has one. Looking for any granularity on pricing, demand trends by geography, specifically benefit close to urban locations, West Coast, especially on West Coast, San Francisco, Portland, Seattle. I would just say broadly, and then I'll maybe have Laura and David chime in here. The demand's been fairly broad-based. We've certainly seen a significant amount of activity in the Sunbelt, Texas, and Florida, but as I looked around our booth, some of the most active meetings that we had were for some development opportunities that we have in Metro Chicago. The most reinvestment that we've been doing has been in our North region. Laura's been at the forefront of a lot of it. And then certainly if you think about what we're seeing on demand on the West Coast, I mean, it's our most well-occupied portfolio. To Tanya's point, to Laura's point earlier about looking at tenants that may be behind a month in rent, our teams are all over that. So I know it's not like to say, hey, it's everywhere, but it's been fairly broad based. I think generally back to that security discussion, it certainly, as we talk to some retailers, top of mind in terms of some of their city locations and how they're thinking about their expansion plans and what that impact is on their pro formas. But it's something, again, that we've been very, very proactive on and on the forefront of. So we've been pleased overall that the demand's been pretty broad-based.
Yeah, I agree with you, Brian. The demand has been homogenous throughout the whole country. From a pricing perspective, Alex, I'd say when you enter the high barrier to entry urban cores where land values are high and you can't build anything else, that's obviously going to push rate. But again, the rate's getting pushed everywhere.
Great. And why don't we take one last question from Caesar?
Hey, thanks. This is more of a big picture, very long-term question, but I'm just curious if internally at Brixmor you're discussing the future of self-driving cars, especially given that you own a lot of parking lot space that can potentially be something else. I think there are quite a bit of advances, especially in Phoenix with some services. And I'm just curious if that's a topic of conversation and how are you thinking about that?
It is a topic, particularly as you think about charging stations and providing appropriate access for electrical vehicles as well. But Caesar, there's a broader theme underlying what we're seeing in the industry and what we're seeing in the municipalities, and that is greater flexibility over what we can do with our parking lots. I think in part because municipalities recognize that these centers can be less automobile dependent, more walkable, more accessible. And the retailers themselves are generating less demand for, we've got to have 5 or 6 spaces per 1,000 square feet of our store. So both on the retailer side and the municipality side, we're seeing greater and greater flexibility, which longer term we're very excited about. We obviously think a lot about where we're placing the charging stations. We're thinking about long-term flexibility as it relates to continuing to provide the retailers themselves with the access points necessary for buy online, pick up curbside, et cetera. But long-term, we like that trend of being able to continue to densify that land that is, in most instances, far exceeds the built-out square footage.
Great. Thanks, Jim. And thank you all again for joining us. Something that we love to do every year, not just to give you the feedback from what we've heard from the conference, but also give you an opportunity to meet some of the other members of our team that you don't always get the chance to interact with. So we appreciate the time and the questions from everyone. As you can imagine, we got a ton of follow-up to get after, which the team has already started doing. But we appreciate it and look forward to seeing many of you at NAREIT over the next week. Thanks, everybody. Talk soon.
Bye-bye.
Thanks, everybody.